Do you want to understand debt concepts without any big words? You're in the right place. Welcome to Debt Set Go, where we decode debt mutual funds and everything around them, one concept at a time. Ready to learn? Let's get started. Do you want relatively steady returns without breaking a sweat? Let bonds do the heavy lifting. Here's how. The blueprint. Invest rupees 10,000 today. Collect rupees 700 every year as interest based on the coupon rate. Walk away with your rupees 10,000 at maturity. Meet your three entities that need money. 1. Government. Imagine the most punctual person you know. Never misses a payment date, usually offers relatively stable returns. Number 2. Corporate bonds. Helps companies grow, offering relatively higher returns than government bonds. Carries slightly more risk compared to government bonds. Number 3. Municipal bonds. Funds local projects like schools or hospitals and offers medium returns which varies by issuer. Here's a mind-blowing fact. Some Indian bonds have a tenure of 40 years. That's 14,600 days of investment. In summary, bonds equal original money back plus regular interest payments. No magic, just math. I want to invest in bonds, but enter debt mutual funds. Imagine this. You team up with other investors. A fund manager does the heavy lifting. Your money is spread across government bonds, corporate bonds, treasury bills, and here's something you may not know. A single debt mutual fund can have 50 to 100 plus bonds. Now, why debt mutual funds? You can start small. Experts manage your investments and you get the flexibility to buy or sell anytime. Choose between growth or regular income options. It's not just an investment, it is smart money planning. Let's understand three core concepts of debt mutual funds. Number 1. NAV, net asset value. Think of NAV like a scoreboard. It shows your fund's current value and changes daily. Higher NAV is equal to your investment growing. Number 2. Duration game. Short-term bonds 1 to 3 years. Medium-term bonds 3 years to 7 years. Long-term bonds 7 years plus. The longer the duration, the more it reacts to interest rate changes. Credit rating. Think of it as ratings for bonds. AAA is 5-star hotel. AA, a good resort. A budget-friendly, decent stay. Pro tip, the better the rating, the safer the bond. But returns might be slightly lower. Here's a mind-blowing fact. Even a 0.1% interest rate change can shake up your returns. Let's simplify tricky bond terms. Number 1. Spread. Think of it like the price difference between two stores. It is the gap between the yields of two bonds. A bigger spread means more risk or higher reward. Number 2. Modified duration. It's like your bond sensitivity meter. Higher duration is equal to bond prices will jump or drop more when interest rates change. Example, if interest rates rise, high duration bonds lose more value compared to low duration ones. Number 3. Yield curve. Imagine it as a line chart showing interest rates over time. An upward slope means higher rates for long-term bonds, signaling growth expectations. A downward slope hints at an economic slowdown. Number 4. Interest rate risk. When rates rise, bond prices drop. When rates fall, bond prices rise. It's like playing seesaw with the market. Yield curves are like the maps for the bond market. They predict where rates might head next. Why did my bond value change? Let's decode the bond yield dance and RBI's magic. Imagine this. You have a bond paying 5% interest, but then RBI steps in. What's RBI's repo rate? The interest rate banks pay to borrow from RBI. When it moves, everything moves. Let's see what happens. Scenario 1. Repo rate goes up. New bonds start offering 6%. Your old 5% bond loses charm, just like last year's phone versus the new model. Let's do the math. Your bond at rupees 1000 at 5%, that is 50 rupees per year. while the new bond rupees 1000 at 6%, which is rupees 60 per year. What happens? Your bond's price must drop until it gives a similar yield. Now, scenario 2. Repo rate drops. New bonds offer lower rates. Your old bond's importance rises. Its price goes up. And a mind-blowing fact, even a 0.25% change matters. Remember the golden rule. Yields up, bond prices down. Yields down, bond prices up. It's like a perfect seesaw. Here are some banking rules that shape the bond market. CRR, Cash Reserve Ratio. Banks must park a portion of their money with the RBI. Higher CRR is equal to less cash for loans. We may see interest rate hikes. Number 2. SLR, Statutory Liquidity Ratio. Banks must hold a fixed percentage of their money in government bonds. Higher SLR is equal to increased bond demand is equal to prices may rise. Here's a fun fact. A high SLR often benefits gilt funds, funds investing in government bonds, as bond prices increases. Impact of CRR. Short-term interest rates rise, boosting returns for liquid funds. Inflation impacts not just your wallet but also your investments. Here's how. When inflation rises, RBI hikes repo rates to control spending. Bond prices drop and NAV adjusts downward. But in the long run, bond yields increase, attracting new investors. Existing bond prices may recover slowly. Example, it's like the price of goods in a supermarket. During inflation, discounts disappear, but sales return later when the demand cools off. Fund manager strategy. Shorten portfolio duration to reduce sensitivity. Favor floating rate bonds that adjust with inflation. Focus on safer, higher rated bonds during uncertain times. And here is a pro tip. Track inflation matrix like wholesale price index and consumer price index. They signal where interest rates might head next. When the government spends more than it earns, it needs to borrow. How? By issuing bonds. What happens then? More bonds hit the market, like adding more apples to a fruit stall. Prices of existing bonds adjust. Bonds yield rise to attract buyers. The impact on debt funds. Higher fiscal deficit means government borrows more. Yields, interest rates on bonds climb. Bond prices may fall, affecting fund NAV. And for you, new investments get better returns as bonds offer higher yields. Smart moves during high deficit, stick to short duration funds. They are less affected by falling bond prices. Explore corporate bonds. They may offer relatively higher returns to stay competitive. Focus on quality funds with a strong track record. Want to choose the perfect debt fund? Start with 3 simple questions. How much time do you have? 6 months to 1 year means liquid funds. 1 to 3 years, short duration funds. And 7+ years means long duration funds. Number 2, what's your risk appetite? Low risk, government bond funds. Moderate risk, corporate bond funds. Relatively higher risk and higher returns, credit risk funds. Number 3, do you need regular income? Growth option means watch your money compound over time. Dividend option means enjoy regular payouts for added income. It's all about aligning your investments with your needs. Let's decode the risks hiding in plain sight. Interest rate risk. When interest rates rise, bond price fall and vice versa. Long duration bonds are like roller coaster. They swing more with rate changes. Credit risk. Lower rated bonds may offer higher returns, but they are riskier. It's like choosing between a 5-star hotel, AAA rated, and a budget lodge, A rated. Number 3, liquidity risk. Can you exit quickly? Some bonds aren't easily tradable. Think of it as a long checkout line. Know what you're getting into. Number 4, reinvestment risk. When a bond matures, you might have to reinvest at lower rates. Even the safest funds need time to perform. Patience pays. Debt funds aren't just influenced by local events. The world can play a part too. US interest rates. When the US Federal Reserve changes rates, global funds adjust. India's bond market feels the ripple effect. Dollar strength. A strong dollar pulls foreign money out of India, impacting bond prices. Keep an eye on currency trends, they matter. Oil prices. Rising oil prices fuel inflation, often leading to rate hikes. Falling prices can ease inflation, helping bonds. Market truth. Global markets are like puzzle pieces. Each move affects the bigger picture. Ever wonder what may change your debt fund's NAV? Interest income. Bonds earn interest daily, adding relatively steady value to the fund. Think of it as water dripping into a bucket. Bond price movements. Bond prices fluctuate with market conditions. Daily mark-to-market adjusts NAV accordingly. New investments. Fresh money entering the fund boosts its size. Expenses deducted. Fund management fees and other costs are trimmed daily. Pro tip: don't stress over daily NAV changes. Focus on long-term trends for a better perspective. Decode your debt fund fact sheet with these 5 key points. AUM, assets under management, refers to the total market value of all the securities held within the fund, and it fluctuates based on the market performance, new investments and redemptions. Number 2, portfolio YTM, your return compass. It shows the fund's potential if held till maturity. Average maturity tells you the average time until bonds mature in the fund. Longer maturity may equal higher returns but more price movement. Credit quality. AAA rated bonds equal maximum safety followed by AA and A. Check top holdings to gauge risk. Expense ratio. Annual cost of running the fund. Lower expense is equal to more returns in your pocket. Always read the fine print. It is your investment guidebook. Speak the bond market language with ease. Coupon rate. Fixed yearly interest on your bond. For example, 7% coupon is equal to Rs 700 annual interest on Rs 10,000. Face value. The original amount you lent repaid at maturity. Think of it as the bond's price tag. Maturity. The bond's end date when you get back your face value can range from 1 month to 40 years. YTM. Total return you'll earn considering all payments, that is interest plus face value. It's like a roadmap to your bond's full potential. Returns are just the start. Dig deeper to evaluate a fund's true performance. Rolling returns. Think of it like watching multiple cricket matches, not just the best one. Check performance over different time frames for a full picture. Risk-adjusted returns. How much returns did you get for the risk taken? Like choosing between 2 batsmen. One scores more runs but takes wild risks, while the other is steady and efficient. Category comparison. Compare your fund to peers in the same league. Check 1 year, 3 year and 5 year performance to see how it all stacks up. Consistency meter. Is the fund a reliable performance or a one-time hit? Monthly track records reveal its stability. Remember, consistency and quality matter more than flashy short-term returns. Don't pick funds like binge-watching random deals. There's a method to the madness. Timeline match. Align your investment horizon with the fund's duration. 3 months mean liquid funds, your go-to emergency buddy. 6 months, ultra-short funds, relatively stable and flexible. 1+ year, short or medium duration for mid-term goals. 7+ years, long duration, long-term wealth builder. Risk check. Match risk with your comfort zone. Focus on safety. Choose government bonds backed by the nation. Moderate risk is equal to corporate bonds, stable with a little edge. Bold means credit risk funds, high risk and may give high reward. Track record. Review the last 3 years' return versus category average. Risk taken for those returns. Fund manager's history. Who is driving the car? Fund house. Check the team behind the fund. Experience, fund size and reliability matter. Cost check. Lower expense ratio means more of your returns in your pocket. Pro tip: bigger isn't always better. Choose based on fit, not just size. Let's simplify the jargon that makes bonds sound complex. Repo rate, the rate at which RBI lends to banks. Think of it as the market's thermostat. RBI uses it to control liquidity and inflation. Floating rate, bonds where interest rates change with the market. Zero coupon bond, no regular interest payouts. You buy at a discount and get a higher amount at maturity. It's like planting a seed and waiting for a big tree. Call option, bonds that allow issuers to repay before maturity. Adds flexibility for issuers but requires you to know the fine print. Master these terms and you're a step closer to being a bond market pro. Inflation can quietly eat into your returns. Let's break it down. For example, inflation is at 5 to 6%, fund returns at 7 to 8% and real returns just 1 to 2%. Smart fund picks for inflation. Floating rate funds, they adjust to rising rates. Dynamic bond funds, they adapt to rate changes. When inflation rises, shorter duration funds, they shine as they are less affected by falling bond prices. Stay flexible and keep a close watch on economic signals. Watch these indicators: RBI announcements, oil price trends, food inflation data. Understanding inflation keeps your investments one step ahead. Debt funds behave differently in each market phase. Here's how to ride the wave. Rising rates. Opt for short duration funds. They are less sensitive to rate hikes. Floating rate funds benefit from higher interest rates. Falling rates. Long duration funds perform well as bond prices rise. Gilt funds backed by government securities are stars in this phase. Stable rates. Accrual strategy works best. Focus on funds that earn steady interest. Watch credit ratings closely. Market truth. Tailor your strategy to each cycle for better returns. Master debt fund investing with these expert strategies. Exit plan. Define your goal before entering. Know when to redeem and your target returns. Review schedule. Monthly quick checks, quarterly review, yearly deep dive. Keep your strategy aligned with market trends. Watch flags. Red flags include sudden AUM drops, fund manager changes. Green flags. Look for steady returns, clear communication and stable fund management. Safety first. Keep liquid funds handy for emergencies. Never lock up all your money. Expert secret. It's not just about returns. It's about staying disciplined and flexible. And that brings us to the end of Series 1 of Debt, Set, Go. If you liked what you watched, do share it with your friends and family. See you in the next series.
An investor education and awareness initiative by Bandhan Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.